Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. And joining us this week is Dayan, who has been a repeat guest. Not going to give him the introduction, but excellent trader, excellent macro thinker. Always has some really unique views that are always of interest. So yeah, Danny, great to have you back on the Roundup here this week. What's going on?
Thanks for having me. I mean, these are some incredibly wild markets. Obviously, the policy set is changing multiple times a day, so a lot to catch up on.
Yeah, absolutely, there is. Quinn, what's going on with you? How's things?
Yeah, it's good, man. It's nice to, volatility's come down, but it's still 26. But it's at least seems like the market's not caring as much about every single headline and blurted one-liner, which is fun to see. You can actually invest or approach investing in these markets at this point. Not that it persists, but yeah. The last few weeks there were just like, it's not investing, it's like coin flipping and buying pukes, panics, and selling euphoria, and it's just like trading like a pendulum. But
yeah, suddenly I felt like I was day trading, and I'm not a very good day trader. I'm much better at like the 3-month type thing, but I was just like, holy crap, like suddenly these things resolve themselves so quickly, and you're like, okay, well, when variance is this high, like suddenly you get a 10% move, you have to rethink everything instantly, and that just happens in a couple hours.
Try writing macro thought pieces, and they expire the next day before people even had a chance to read them. So yeah, I get it.
It's like a 12-hour shelf life. Like you tweet something like yesterday or the day, whatever day it was, like, oh, short gold, and then it craters 3%. You're like, well, I guess I should close this. Like,
yeah. Okay, Danny, you've been writing, to your point, even though you're saying that your Substacks are stale within 12 hours. A couple of them have actually been really excellent in holding pretty sturdy here. And one of them was you wrote this thesis about being beware of the doom loop. And I think this was even before Liberation Day you wrote this. So very prescient. And yeah, you really laid out a couple frameworks for how to think about things here. So we're in this world of basically rethinking capital and trade flows, which really impacts everything. So I'd love to just open the stage for you for a few minutes to just really explain this potential doom loop and what are some of the different scenarios and how is that tracking. And I think it's been about 3 weeks or a month or so since you originally posted that. So yeah, I would love for you to just explain to the audience what that entails and where we're at in that process.
Obviously, everything changed, I think, late February when we first saw stagflationary survey data on the S&P PMIs. So the equity market had been going down every single day, since then. And I wrote a note before I even got into the doom loop aspect. I wrote a note called, the doomsday, which I called it, and the demographic time bomb. And the, colorful title, not supposed to make you jump off, a bridge or anything. But the thought was there are two major vulnerabilities to equity markets to consider how far they could go if these play out. Okay, I'm not predicting they play out when I wrote this, and this was before Liberation Day. And the two of them are, one, if foreigners who are heavily exposed to U.S. assets, they're roughly 25% of the equity market, roughly 25% of the free float of the bond market. There's even more in credit and other things like that as well. But overexposed to the U.S. asset side of the story. And frankly, this has been a very confrontational trade policy on top of it. And I went through the mechanics of what would lead to an exodus of this capital. And I'll come back to that in a sec with the doom loop framework. The second was baby boomers. And baby boomers, are the wealthiest generation in history. They've pretty much retired. The median age is 70. According to typical, age structure models, demographic models, they should be at very low allocations to equities at this stage of their life and should be much safer front end of the curve, like savings, etc. But from what I'm seeing, they're still very heavily exposed to the equity market. And this audience owns about 17 trillion of equities. And so the concern would be that if either or both of these groups just get really nervous and start selling, the low will be significantly lower than what a standard correction or standard recession or whatever metric you look at to say how far the market falls. These dynamics suggest there will be more downside. And then, coming into Liberation Day, I started to see behavior where, prior to the initiation of the Trump administration, the expectation was the dollar would strengthen against tariffs, and that the dollar strength would offset some of the impact on inflation from the tariffs. We've seen the complete opposite. And so, going into Liberation Day, we started to see the dollar trade actually pretty weak almost anytime there was an announcement. And so the doom loop thesis that I put out is basically looking at the last time we had a major exodus from the United States in a fashion that policymakers could not control was 1979 through 1981. And, in that situation, you had stagflation. And so stagflation is the most difficult to tackle from a policymaker standpoint, because which one do you prioritize, right? If you prioritize the unemployment side or growth side, you cut rates, right? But you worsen inflation. And so, you have to prioritize one or the other. And the way it played out then is a concern for now as well, where when you have the dollar weakening as rapidly as it does, this becomes the new constraint for you. And the dollar is not something that policymakers control. They don't control that. The Fed controls the front end of the curve, the Fed funds rate. They don't control the dollar. Neither does the White House, right? The dollar is free floating, and so is the long end of the curve. And so, the concern was that almost everything that we would do in response to a typical growth scare or risk off scare would make this dynamics worse. So here's how the doom loop works. We already have an inflation problem. Inflation's been sticky for 4 years. It has been reaccelerating since September, although the most recent month was somewhat noisy and softer. But we still have a sticky inflation problem of core CPI in the 3.5% give or take trend range. And then we're introducing this stagflation shock, of course, but also a balance of payments dynamic that has come out, because the White House is quite clear, the president is quite clear that he thinks trade deficits are a bad thing. And he wants to narrow the current account deficit. I think most people in economics would disagree with that, thesis, but that it's a bad thing. But he does. The issue is that there's multiple factors at play with the current account deficit, and there's multiple ways to calculate it. So everyone knows that it's exports minus imports, and the U.S. being an import country will have a current account deficit. But the other mathematical property for the current account deficit is savings minus investments. And so the US has very low household savings rates and a very high investment rate. And that's what makes the US economy as dynamic as it is. To give numbers, the US household savings rate is about 4.5%. And that actually rose recently from 4%. Europe, Germany is in the 8s, Canada is in the 7s, China is way higher in close to 40%. And so if you want to narrow the current account deficit, it means either raising savings or reducing investment. Both are bad for growth. So that changes the U.S. exceptionalism story in a big way, which is why foreigners are as invested in U.S. assets. But the other mechanical nature of this is if you narrow the current account deficit in trade, you are supplying fewer dollars to your trading partners on a going forward basis. And so if I supply you with fewer dollars, that means you have fewer dollars to buy US assets. That means the risk premiums on these assets need to go up. So now what is the doom loop? The doom loop puts all these things together. And the issue is when you get a really rapid decline in the dollar, it raises inflation. So again, back to what I said earlier, we expected the dollar to come and be stronger to offset the tariffs. In fact, the dollar is very, very weak, and it's exacerbating the impact on inflation from tariffs. And the more the dollar weakens, the more we will have inflation. And so the market started to sniff this out, where as the dollar kept weakening, the long bond, the 30-year, the 10-year, these bonds started selling off pretty aggressively. And so when we have, the equity weakness that we have, everyone is out there, with the usual playbook: cut rates, right? The Fed should come in and cut rates, or the Fed should cap the long end by doing like yield curve control or QE. The issue with that is either of those things will crush the dollar and will raise inflation further. So I'm not saying that this all has to happen in a violent way, all in the span of a month in a crash way. This could play out over multiple years. But just like in the 1979 to 81 episode, once this train gets going, it's really hard to end it. And the only way you end it is to stabilize the dollar. And the way you stabilize the dollar is by making US assets so much more appealing than foreign assets that you're not worried about what the dollar does anymore. Like, if I'm able to buy, the NASDAQ at cheap levels, so cheap levels like that we haven't seen in a long time, but if they're that cheap, I'm very confident that in a 3-year or 5-year horizon, I'm going to make money. I'm not worried about the ebbs and flows of the dollar anymore. But at this level, I am. And so the equity market would need to reprice significantly lower to stabilize the dollar, or bonds would need to reprice to significantly higher yields to stabilize the dollar. So the doom loop is that any sort of action you take other than hiking rates will keep this going in a self-reinforced way. Now, alternatively, Trump could cave and drop trade wars, and we're getting a little bit mini walk down as I believe he's hit some constraints, and so things have settled down, in the short term. But I think in the medium term, we still have this dollar doom loop, situation as a major risk to think about.
What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. But I want to get your take on any of those aspects and how you're thinking about them.
I agree with most of it. I think the dollar weakness was inevitable. I think it's a classic case of, assigning narratives. You always have to find what the narrative is that assigns price movement, but which I obviously this cluster commotion is attributed to it. But I think there was fading momentum on, I basically view the dollar as like blowing off into January on US outperformance, and this move really down, I just see as all the people that piled into US tech stocks who are late and now got washed. And now we're kind of, okay, multiples are more normal relative to rest to Europe and Japan, et cetera. Dollars at a more normal level. Even historically, it's the dollar's come down, but it's not like it's, the end of the world for it. But I do think that secularly, I'm kind of still bearish dollar because I don't think it accounts yet in price for the economic weakness that it appears the Fed is going to probably be okay stomaching by being delayed on the rate cut side, right? Because there's this trade-off that they're clearly want to be, slow to act, and I think that has consequences on the economy as a result. True, like over a long term, that sort of behavior is probably dollar strengthening if they're not printing, easing financial conditions and rates into, what could be inflation. TBD, we'll see. But yeah, I think the interesting thing is like when that commodity and inflation trade works, because in the meantime we're battling downward economic growth headwinds, so people aren't as concerned about that strengthening tailwind for commodities and inflation. But I think the second we do see stimulus, it becomes a problem. Danny, I'd be curious. I thought that's an interesting way to frame the dollar stabilizing. I've been thinking about it more so like when the Fed actually, in the time of crisis and there's an inflation problem, kind of chooses to reduce inflation and not act. But it's the same thing, because in that case, you ding assets. I'd be curious because I think we probably agree on the long bond. I don't think the risk reward to the upside is that great. And at some point when they have to step in, it probably blows out in terms of bond yields. Just curious if you have any thoughts on timing that move, because obviously that's key. Like the tantrum we had, I didn't buy the like China thing. I was more basis trade, margin, balance sheet compression, VAR event camp. And so, I'm in the back of my mind, I'm thinking, okay, let's say we do get the next leg down in risk in the next couple months, and everyone's thinking that, okay, that same deleveraging happens. I wonder if like it's a true growth scare, this next one, and yields come down first. I don't know, but I do want to play that short bonds when it's here. I just don't know on the timing.
You raised some good points. First, to just say, the dollar selling off on its own shouldn't be a problem. It's a problem in a stagflation scenario. And you're right. We came from a really very richly valued starting point in equities, in bonds when we were below 4%, 2 weeks ago, and in the dollar by all purchasing power, parity metrics, or whatever valuation tool, which are tough to time trades on. But those metrics suggest the dollar is historically overvalued. And so, I think corrections in these make sense. What I'm getting at is this is a difficult dynamic for policymakers because it feeds on itself. So if you actually go back to that most acute phase when we were getting all three, dollar down, stocks down, bonds down, I think the interplay between them is important to think about coming forward. So first we would get equities, obviously would be getting, killed. The volatility was quite large, right? Like we were getting these really large moves of 8-10% swings in a day, multiple days in a row. But as that happened, you would see the front end, the 2-year go bid. You would see December 25 SOFR go bid, pricing more rate cuts. When that would happen, the dollar would weaken further and the long bond would weaken further. So in the doom loop situation, what this is telling you is this is the wrong medicine. This is not the medicine we need. And I'll just use a fundamental reason to explain that. Imagine the Fed cut today 50 bips, emergency cut. Do you honestly believe businesses are going to be like, great, we're now investing in a big scale or higher rate? No, because the uncertainty around this trade policy is not going away just because the Fed cuts 50. Now, if the Fed cuts 250, yes, like you will see that, but they obviously cannot do that, right? So, the Fed cutting 50 bips, which probably is the most they could do, is the wrong medicine. And the bond market was rejecting this. I was watching, I had a famous tweet, the bonds are about to get destroyed, and I'll kind of give the story behind that now. For 3 weeks, I've been telling clients, we're pricing in the bond market the weak growth part of stagflation, but we're not pricing the inflation side of stagflation because we were just rallying, from 450 to 420 all the way to 4%, as equities were going lower. But what I noticed was on, the 2 days after Liberation Day, the bond market had rallied like 15 bips each day and reversed back to flat by the end of the day. In fact, I think in a couple of days, the 30-year yield was higher on the end of day close than it was before. And the front end is people saying, please save my risk assets, cut rates, or please save the economy and cut rates, whatever it is. But the long bond doesn't panic. The long bond doesn't freak out like all the other markets were. The long bond was pretty darn chill throughout this whole episode. And I had watched then we had the Sunday night, we opened again down 5-6% within minutes of the futures open. Again, bonds rallied and then they slowly were going back to unchanged on the day. And I looked at this pattern and I said, this is exactly what happened in the summer of 22. This is exactly what happened in SVB period. And this is exactly what happened in August of last year, where the front end went bananas, well bid, but the 30-year was very calm. And the 30-year was calling, BS on this, and this is going to lead to inflation. So I thought this was coming. It was very hard to time it. And if I couldn't time it throughout that 3-week period, although I did end up timing it very well then, it just shows you like how it'll play out over the course of this year. I don't think it's super clear, but it's telling us that, this is the wrong medicine and for a stagflation issue. And so I can't tell you what the Fed will do. I don't know if they will prioritize the growth side or the inflation side. I think they are very possible going to have to they're going to have both of them away from their mandates and have to make a choice. I know what I would do, but I don't know what they would do. So I can't say this is going to happen, but it's pretty clear that that would be the wrong medicine for the inflation side of things. And I think that's what the bond market's been telling you. And I think that's what the dollar's been telling you as well. The dollar valuation, most people look at nominal rate spreads, but the most sophisticated FX participants look at real rate spreads. So let's just say the 2-year real rate differential. If we're pricing higher inflation and lower front end rates because we're cutting rates, you're pricing materially lower real yields. That's what's getting the dollar to get crushed here, right? And so I think, as this plays out, we'll have to see. Hopefully the White House, is able to stop this before it cascades too far. Right now, the hard data is still strong. The trackers that I have for the hard data are still very strong, meaning jobless claims. We got another print today, is very low. Non-seasonally adjusted 209K. There's like literally no issue in jobless claims. Tax receipts still very strong. Red book sales, 3 hottest weeks since 2022. Consumers are spending. Mortgage applications bounced in the midst of that risk off by 10% 2 weeks ago. Suggests there will be some upside to housing data 2 months forward. None of the trackers are suggesting that we've hit that breaking point. So, I think the White House hit their constraints and they're toning things down. Will that be enough? I'm skeptical. But we'll have to see.
Yeah, there's some really interesting points in there. It feels like, basically what we've experienced is that this initial impulse has been the speculative position reversals. And to Quinn's point, that happened at a moment where everybody, like if you just look at the sentiment surveys from back in January, everybody was all in on US. And we've seen that recalibration now. But if we think about just referring back to that doom loop thesis, if it's related to the narrowing of the current account deficit, we've actually seen a huge widening in the current account deficit because of all the imports that have been front running the tariffs. So this mechanical doom loop has not actually happened yet. There's some speculation and changes of the marginal trader in terms of going back to the euro and et cetera, et cetera. But for the most part, that actually hasn't really happened yet, and it feels like that will be the next theme. And obviously, what's dependent on that is what actually happens in terms of trade policy from here on out, and whether we actually see this continued push towards the narrowing of the current account. But I do think it's important to reflect on the fact that we actually have a widening current account right now. And another thing you said in there, Danny, that was really interesting is just this idea of looking at the real rate spreads as opposed to nominal, because you actually brought this up in a recent note as well. But obviously, there's a lot of different ways that people measure real rates. You can look at like break-even, swaps, even CPI, or even survey data. And each of those are going in a different direction right now. You have the survey data that's saying that, like, we're talking about, I think, like 5% plus inflation expectations. You have the break-evens that are actually pretty flat. So when you look at the rise in bond yields, real rates are actually going up because the break-evens are staying flat. So then, you have some people, and to be honest, I was in that camp, which is that, okay, look, this is like a term premium thing. It's not a real concern about inflation. That's because the break-evens are flat. So yeah, I would love to just hear what's the right way to think about real rates here. And you brought up an interesting point about how I think it was the break-even market has some issues with it, just in terms of the liquidity and how that gets priced.
I'll address the break-even market first, and then we'll go through this. But the break-even market is far smaller and less liquid than the treasury market. So we already have an issue where the bond market, the messaging from the bond market can vary 1 month to the next. It's almost schizophrenic, right? So this is like 10-year yields were 385, then they were 460 4 days later. Like, saying the bond market knows all has been a losing proposition all cycle. And then now you talk about the less liquid tips market, which, if you go back, I have a long-standing gripe with the tips market this cycle, because if you go look at like 1-year inflation swaps, every January 1st for the last 5 years, it's missed inflation by a mile every single time. And so I think people far too often look at this market and say it's the wise one, and we can just take the message inflation is not an issue. Inflation expectations are not an issue. No, I think what really happened in the last few weeks that made real yields look higher than they probably are is these positions were dumped, just like other positions got dumped. And it's such an illiquid market that if anyone with size was dumping 30-year tips, it led to real yields just mechanically moving higher. I think that market is frankly nonsense. But what is it telling us? 1-year inflation is, looking at 1-year CPI of a surge up to like 3.5% to 4%. It's been in that range. And then the 2-year or the 1-year forward is closer to 2%. So the inflation swap market is telling you this is a transitory inflation shock. I'm coming to the conclusion recently that it's not, that it'll be a lasting inflation shock. But that's what that's telling you. The University of Michigan surveys, I think people dismiss them too much. And I'll explain why I think that's a real issue. A year ago, I noticed that the famous, University of Michigan has the 1-year inflation expectations and the 5-year, 10-year, 5-year to 10-year inflation expectations. But what they publish is the median number. And I noticed a year ago that there is also a mean, an average inflation expectations in that series, and that these two, which never diverged in the history of the database, started diverging. And so the mean was going up to 4.5% starting April of last year. So everyone who talks about this as a political survey, this started happening under Biden before the election was even ramping up, before we knew Trump was a front runner to win the election, all of those things. If you remember, he really gained steam after the shooting incident there. This was well before all this, and it started going up April last year. And so I remember last year thinking to myself, why are we looking at the median, right? So just let's think about this for a second. If the median long-term inflation expectation says 3%. All that means is half the numbers are above and half the numbers are below. But the ones that are below could be 2.9%, and the ones that are above could be 10%. Telling me the median is 3% doesn't tell me anything. If the mean, which is the average of all the numbers in there, is rising, and like it is now to 6-7%, that's the story. And that story was foreshadowing, the mean number was foreshadowing the median now going up substantially higher. So from my perspective, whether it's the household sector through the University of Michigan, we also have the conference board measure, and we have all the business surveys. All of them are telling you inflation expectations are unanchored. So my opinion is that inflation expectations are unanchored. And the other thing is you have to look at behavior. If you have unanchored inflation expectations, what's the textbook behavior that you expect to see is, well, I'm going to buy things today because I expect prices to go up in the future. We just saw that in the huge, current account deficit numbers, the trade numbers, like you said, but also the huge auto purchases in the retail sales that we got last week, which was, the highest number in 5 years, and was because people expect prices to go up. And so they buy things today that's because they expect prices to go up tomorrow. They may not have needed to buy that today, And so that's how I look at it. And then real yields, I would say we should compare it, because I think the break-even market has frankly been broken all cycle. I think we should compare it to actual inflation, so just CPI. And from that basis, if 1 year CPI is expected to rise from a 3% to 3.8, and you're pricing the Fed funds rate at the end of 2025 to be 3.5, you have a negative real rate is what you're pricing in. And I think that's part of what makes the dollar unappealing, to foreigners at this stage.
Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply.
Yeah, I agree. Like we were pointing the inflation expectations thing out. It was well before, it was in February even. Jan and Feb, you could see it starting. And the funny thing is there's always this argument or like debate that people have around one, like the Fed's target for inflation and a lot of the things they communicate, which to me, it's like, one is the Fed going to ever announce they're okay with inflation? Back when people were like, the Fed, they can't believe they're going against their word when it's above target. It's like, you think the Fed's ever going to say, no, we're okay with inflation above target? And the same goes with expectations. If you look back to 2021, and they basically it's what they do with inflation, X this, then it's super core, then it's X this. They find any metric that supports their case that inflation expectations are well anchored. They switch to market-based, then they switch to survey-based. Of course, because, it's like, is the magician going to tell you it's all fake? It's not a fruitful debate. And, they would crush their abilities and objectives if they ever were to admit it. But it's like, I totally agree with Danny. Like, it's so obvious they're unanchored. And they're, if you read between the lines, Powell and every, communication has thus far respected it. And their actions and words are, very hawkish, that they're going to wait. Today, Waller, I think he said like at least July, maybe he expects clarity, which to me.
And he's a dove.
Yeah. I personally don't think risk assets stay up elevated until July if there's no stepping in. So anyways, I just think that's a funny point where it's like everybody in the world, like obviously they're unanchored, and obviously the Fed will never say they're unanchored.
Great points. And if you go to the 1970s, they got unanchored because the Fed was telling you, we can solve inflation at any point, but we don't want to. We don't want to cause unemployment, so we're not going to solve it. Well, when you say you can solve it, but you're choosing not to, inflation expectations get unanchored. It's the same story here. And, the Fed, why are we in this situation? Well, for 4 years, we've had above target inflation. The Fed chose one of two paths. One path was the path like guys like Larry Summers were saying, you need to crush the economy to defeat inflation. As much as he was wrong, he was also right because we haven't defeated inflation. But that's the Volcker. You destroy it and it's gone. The other path was this gradual disinflation, soft landing over multiple years. But the problem with that is you leave yourself vulnerable. The Fed leaves themselves vulnerable to one of two things. One is inflation expectations can get unanchored, which in my opinion, we were starting to see that last year in the mean series. And I was warning about it every month. No one cared to hear it because equities are flying every month. But the second thing is you leave yourself vulnerable to a shock, right? If inflation is above target, a shock can then cause a new inflation cycle. And here we have a shock. It's just that it's a self-imposed shock, but it's still a shock nonetheless. It's not like oil due to like some third, country, third party or whatever saying, we're cutting off oil exports like in the oil embargo of the 1970s. But here we have a supply shock by choice, and they left themselves vulnerable to this. So now, the ironic thing is the Fed thinks they're being hawkish by saying we'll be on hold to see how this plays out. I think that's part of the problem. The part of the problem is, and I don't know which one they should prioritize. This is really difficult. It's beyond my pay grade. But you haven't being on hold at higher levels than here didn't get us to target. And why you think being on hold here will be enough in response to 5-6% inflation? Even the Fed governors themselves are saying we may get 5-6% PCE, and we're just going to be on hold, and it's all just going to go away. No, the Fed has no plan. They have no plan to deal with inflation which is an if, it goes to those levels and then stays there. What does the Fed do? Staying on hold is not going to do it. And I'm actually leaning towards it going, maybe not staying all the way that high, but it being more persistent than people expect. I do not think this is a typical supply shock. And everyone's applying the textbook supply shock here. And I think they're making a mistake. And so here, I think as we go forward, they may cut in spite of that, in spite of what I'm saying, which will only make it worse. And in my opinion, means that we will get, the doom loop. But, in my opinion, it's gonna give them a real issue down the line. We have an inflation hurricane coming, is what I've been saying.
They will cut. It's just a matter of when. I think it's like how much pain first.
Yeah, I think okay. Let's set the stage here a little bit and shift into how we're all navigating this tactically as traders, because obviously it's one thing to wax poetic like we have been on these big ideas, but I think the characterization that even though we're talking about doom loops, deficits are actually widening. Taking that mindset, I want to start to explore with you guys around how you guys are tactically navigating these dynamics. So let's set the stage here and just think about the fact that, okay, you have, obviously Liberation Day was the maximum effective tariff rate of, just above 30%. We've been slowly walking that down to wherever it is. I don't even know where it is right now. Like maybe let's call it 24% or something like that. So still obviously significantly above. I saw it today. We finally got the first insight into the data in terms of actual tariff revenues that are being captured. I think it was something like $60 billion is captured. So there is something starting to happen there. But then you pair that with what's going on the fiscal side of things in terms of deficits. We've seen Doge be, just a total nothing burger. Basically, it's gone from, I think it was originally 2.5 trillion to 1 trillion, 150 billion, and now Elon's leaving in May. So nothing got caught there. We have potentially more tax cuts coming down the pike. We have a Senate bill that is actually talking about significantly increasing fiscal deficits. So all that to say is that the idea of I'm not going to go as far as say outright fiscal dominance, but fiscal deficit heaviness affecting the economy is looking like it's only going to accelerate from here on out. So I'm curious, each of you, to hear about how you're thinking about, on one side of the train, you have the same as it ever was in terms of some of the drivers of what led to high equity prices, which is high fiscal deficits, if that increases, but then on the other side of things, you have potentially this beginning, maybe just whispers of the doom loop capital unwind from the rest of the world. How do you guys both navigate those two levers? Does one offset the other? Does one, like, do you weight one more? And basically that leads to, do you long equities or do you short equities? Not sure which one of you wants to grab that first.
I'm looking at equities as, and I'm actually tactically long. So there's a difference between putting out a big picture macro view and trading. And I think this gets lost in the nuance on Twitter. I have to trade the tape in front of me. And right now, I think we're taking the temperature down. And so every incremental headline we're getting is so far about taking the temperature down. But when we get past this sort of, we came to an understanding of an agreement with India, Japan, and South Korea, and we deal with the reality of the situation. You have the two biggest economies in the world with trade embargoes on each other. And what is the de-escalation scenario is returning the tariff rate to 60% on China. This is still enormous. And we have a minimum tariff rate of 10% on the entire world. That is what Trump has said. And so when we previously were optimistic about things like reciprocal tariffs bringing rates to zero, that's out the window now. We're talking about a material impairment to trade as opposed from this. So in my framework, I see this as stagflationary. It doesn't mean it's exactly like 1970s of 10% unemployment, 10% inflation, but it just means we'll have some stagnant growth with inflation. And so I think that, when I look at the deficit story, it only adds to the bond bearishness that I think will prevail over the course of this year. I think the bond market to start this year is sniffing out the permanence of these things. The deficits are out of control forever, and that inflation is not getting solved and is sticky. And so I think even if we get a little bit of an improvement in the growth side of things, then that's also bearish bonds. And so I think equities are just going to have these headwinds throughout the year. I just think it's not going to be a wonderful year where we had this Goldilocks situation where you had, 3% inflation, but the Fed is not going to tighten. They take that out the window. Well, that just flatters revenues a bit, right? And if anything, it was a boon for equities to have that. And you had also, they're quick to cut in the event of any sort of growth scare. They cut 50 bips for a 4.3% unemployment rate in September. So equities had this perfect situation, plus the AI story, plus the, flow of funds story. I think it just is going to be very choppy. It doesn't mean that we have to be down 25, 30% this year. We could end up zero. But I think it's hard to see a sustainable bull run. And so I think you look for opportunities to rent the market, not to own it, frankly. I think the dollar is going to weaken materially from all the dynamics that we talked about. And so I think I look for opportunities to short bonds. I've been re-shorting in recent days. Today was not fun. But I think, that remains, the story as well there. But on an overall, portfolio context, I'm very light on positioning. I'm very light on line items. If I normally run 30 to 50 line items, I want to run 15 to 20. I want to have a huge cash balance. I want to have the ability to react to extremes and be able to react to, the VIX goes to 50 and I want to sell, VIX futures or buy SVIX or something. I want to have the room to do that. I want to have the room to fade, the bond market on a Sunday night when, we rally to 385 and it can't stick there. I want to have the ability to say this equity market may rally further than it should. It gets people sucked back in. And then I can go and fade that. I want to be very lean and responsive to that. Part of it is I've had a good start to the year. and I don't feel like I need to chase anything or generate P&L from here. So part of that is my own circumstance, but I think in general, as a tactical macro trader, I'm looking at this and saying I want to be very lean, and also, frankly, the way this could play out, the scenarios, you know me well, Felix. I think in terms of probabilities and scenarios, the things that I can come up with are just out there. The way this can play out, it doesn't mean any of them is going to happen, but the way that this could play out is really the range of outcomes is really, really wide. And again, I think you want to be prepared to respond to that. Be ready to respond to that. So that's how I'm thinking about it, from a markets perspective, positioning.
Yeah, I like it. I mean, I've been bearish, had the bear goggles on since earlier this year. And so it just kind of, I think mentally, the investing's mental game as much as it is an analytical game. And I thought that going into the year, one of the biggest like things you could do to be in the right headspace is eliminate the last 2 years of asset returns from your memory, because those were record unique circumstances that don't come around often. And also it pulled forward, just like when you go out drinking and pull forward all the fun from the next few days. That's kind of what happened, and we're digesting it. So for me, it's like finally there's a year, being macro oriented, where the most interesting trades are not just long the S&P and NASDAQ and walk away. Like finally there's actual markets and some action, which is interesting. And I think it continues to be that way in many cases. I think that the bond market is more interesting than it's been. We've seen pretty crazy steepening. I would expect that to continue. And I do think the Fed's going to act. They all seem to still think they're restrictive. And, it just that this recent pain wasn't enough. It didn't hit the hard data enough. But I think, the next bout probably will be a result. It will be less, quote unquote, self-inflicted than this market tantrum. And so, the things Danny's laid out I really agree with. And yeah, it's funny, maybe talking on gold for a second, we obviously had it's gone parabolic, and it's been able to perform during the mayhem, as maybe some people say it's front running liquidity. Others say it's simply just the weaker dollar, other central banks. Cause when I look at the range of outcomes, bond steepening, dollar weakening, it is favors gold over many other risk assets. And the question I have for you guys maybe is like how much of that is priced in already, because everybody, it's obviously a very crowded trade at this point. But then when I think through of what's going to happen, it's like, it's not that I'd have a hard time calling like the top in gold, because I just see like more of the same going forward and just this stop start of these mini runs. But it's an interesting one to me. And then also like being, I'm in the US anyways, you guys aren't, but it's very easy to think about asset returns in like dollars or your local currency. But then when you like, because we're not used to having 10% currency moves in 2 months. And so I think that's another very interesting thing for people to keep in mind, is like just relative value. And for me, I just see gold trade as like all fiat getting crushed. But you're losing real purchasing power right there if you're not in it, so yeah, a lot going on. But like Danny said, I think, you don't have to be in every trade. You don't have to be in equities. You don't have to just, hide out in Mag 7. It's like, there's a ton of interesting things going on, and it's probably not going to be a 20% year for stocks. So if you can pick up a couple percent each month doing interesting things, fading extremes, like you're probably going to walk away with a good year.
Yeah, those are so many good points. And I think another one I'll add too is just how when we get into these regimes of high volatility, you have to sort of reset your thinking around just how quickly the resolution of trades occurs. Because, I was just looking, and, NASDAQ is up 16% off the lows. So the way, even though that only happened in like a week and a half, 2 weeks, right? Like in a decent year, that's an entire year's return for the equity index. So like you need to be. It's easy to just be lost in how little time has transpired since you got bullish in equities versus, oh crap, Nasdaq is up 16% from when I was bullish on equities. Like, should I be rethinking that, even though it's only been 2 weeks? And I think a lot of people are going to get caught off guard by that, by how quickly these trades resolve.
The week leading up to the bottom, or like that Thursday night, I was like, in the next 4 days, I think I said 4 or 5 trading days, we're going to get the bottom and risk. And I said, it's probably going to be one of those big multi-week to multi-month bottoms. And you can get a move back up, I said, to 5,500 on S&P and some, high 80s at least to Bitcoin. And then, we get the famous tweet or whatever. And then people ask like, hey, still bullish? And it's like, well, from a time perspective, I should be, but from a price, you're like, hit the exits. Like it's madness out there. You just have to be re-underwriting your cases like daily. It's truly incredible. And part of that though is just like how it's not normal. All right. Like part of that is extremely low liquidity. All these pod shops that got blown out that represented huge amounts of the volume, extreme deleveraging, which in itself is a signal to just, be on your radar, and goes to Danny's point of keeping more cash than you normally would.
I tend to be like a 1 to 3 month horizon, sort of macro views, and put, trades on for that perspective. But these things are moving very fast, so when I went short bonds on that Sunday night, I ended up taking it off 3 days later. And then I put a new trade on and I took that off 2 days later. That's not normally how I'm trading. A couple days ago, I tweeted, I think dollar yen is about to bounce. I think gold is about to sell off. Both of these were just like signals that just hit in my, technical analysis. And, I tweeted that. I don't usually tweet trades for the reason of you don't know how I'm trading something, and you don't know if I stopped out, if I exit. I don't want to like update people, every 30 seconds. But, I took all these trades off 24 hours later. Gold had, what was it, like a 4.5% swing in a day. Dollar yen had a 2.5% swing in a day. These are gifts. If you put a trade on and you think something's going to reverse, and it'll reverse over the coming weeks, and it comes in one day, it is an absolute gift. And you have to take that P&L. There's no sustainable trend here, because the way this can play out can change with these tweets and announcements every single day. We don't know the response of the Fed. We don't know how bad the data will get. We don't know which side of the mandate will be dominant, which side of the mandate they need to prioritize. I'm a little bit more neutral on saying which side. I think both of you guys are leaning that they're going to support growth. I'm not convinced that they'll choose that side. I think there's a pain threshold where they might, but I don't think we'll get to that. And I think the inflation side is going to be too difficult for them to do anything. But, I could be wrong. And so it pays to, again, be nimble, humble. Don't try to think that you have everything figured out. The smartest guys in the world who manage tens of billions aren't thinking that way today. They're thinking in probabilities and scenarios. They're putting trades on. If things go their way, you take your P&L and be happy about it. And it lets you fight another day. That would be my best advice to the audience is risk management, capital preservation. These are more important than being a hero in markets, and just be very nimble with your views, and be humble. That this could play out in ways you haven't envisioned. That would be how I look at it. Things are moving very fast. This week, the VIX came down from 30s to 26, which is I think the lowest it's been in a solid month, right? Obviously, the VIX is not tradable. VIX futures are, and they price at different levels than the VIX. But 26 is kind of almost near the forever average of 20. So it doesn't seem like we're in an exceptionally high vol regime. But we moved 2% on the S&P today. We moved 2% yesterday, and we moved 3 or 3.5% on Monday. These are huge moves. As Felix said, 16% off the lows, in a short period of like 10 days. The volatility is large. And so, there's great trading opportunities if you can do it, but don't get married to anything, in my.
Question on that view, Danny, around not being sure the Fed rescues growth as quickly, which I'm sympathetic towards. I don't, my view that they will is like over some horizon. It's not like eventually. And I think there's a lot of questions, like you point out, as to when that would be. And what I've noticed among a lot of investors is an assumption really that they are going to, and that, they will act, that those recent speeches where they said they'll step in, but we're very far from things breaking in the sense of financial, that's not just over levered hedge funds. So I guess my question would be if I had the view that they're not going to cut for a while, let's say longer than the market, I would almost think that then we go to a little bit of a bull flattening of the curve. Well, maybe even not bull, maybe just a flattening where the long end does not go anywhere really until that comes. Do you agree with that? Like, assuming then higher for longer means growth comes down, the higher they stay for longer, the more likely it is that inflation won't be a problem. Not saying it's not gonna, but it goes in that. Would you agree with that, or you're kind of just like easing into that bond short over time?
So we have 100 bips of cuts, give or take, priced in. Like Z5 is at 350, right? So we've already priced in easing. So that's what I think is difficult for people, is that if they just deliver the easing that's priced, that will not be a financial conditions easing, right? I do think the equity markets will like it if they act, because the act of cutting gives you the impression there's more behind it. And we don't know how much they'll do, but once they start, you always think there's more behind it, right? They started in September, and I would not have thought, given the data we got in the months after that they needed to cut in November or December. I understood the September action, but I don't think they needed to cut in November or December when the data we got showed that this really was not as big a deal as we all thought. So here's some interesting points on the Fed. Powell has, given speeches since the March FOMC that are more hawkish than he was then. And the minutes from the meeting were more hawkish than he was then. I wouldn't call them outright hawkish, but he was very clear. We have an obligation to keep inflation expectations anchored. We have an obligation to ensure that if this is transitory inflation, it doesn't become persistent inflation. He's been more adamant about that than he is about saying, unemployment has to be X. So we're at 4.2% unemployment right now. That's their measure of full employment. We're above target now. Imagine we get to 5%, 5%. 5% inflation, 5% unemployment. He has said, we will prioritize the one that we're further from target. That would be the inflation one, not the labor one, right? At a 5% unemployment rate. Now, if you're talking a 6% unemployment rate, then you're equally as far from both. And it's very obvious that I think they're going to be cutting aggressively at that level. If we have a 4.5, 4.6% unemployment rate and 5% inflation, I think people are way too confident that they're easing in that result. And I think that's the area where, keep in mind, we have persistent labor shortages. We had huge labor supply for 2 years. That's zero now. So we're going to have persistent labor shortages. As bad as things have looked in the surveys, we now have financial conditions have eased quite a bit from this temperature being taken down. If you're a CEO, even if this was to turn into a recession, this is not a financial crisis recession. This is not a recession where there are huge imbalances in the economy like massive deleveraging from households or corporate sector that makes it a worse recession. It would be a garden variety slowdown. That is 2 quarters of crappy growth, some job losses, but it wouldn't be, a cascade of the end of the world recession. It would be a garden variety recession. And a lot of CEOs would be like, can I really afford to fire my staff today and 6 months from now I'm scrambling to get them back? Or do I instead hold on to them? So we may have growth weakness without it leading to a huge layoff cycle. And I think people should be open-minded to that outcome because of these dynamics. It's possible we get layoffs, but it just doesn't grow to the level that people think. So what I have come to the conclusion is that this is not a typical supply shock. And because I've come to that conclusion, I think inflation is the bigger problem than I think the growth side will be. So I'll explain what I mean by that. Brad Setzer is a great economist, and he said this is equivalent to $100 increase in the barrel of in the price of oil. So we go from $60 to $160 tomorrow is the equivalent of the tariff shock of what we're hitting the U.S. economy. So let's work through this. In a negative supply shock of oil going up for whatever reason, like Ukraine war or something of that equivalent, it hits the demand side and it hits the supply side in different ways. So the demand side is obvious. We all spend money on oil every day by driving our car, go to work, take your kids to school or whatever. We cannot avoid spending on oil. Demand destruction happens because what I spend additionally on that extra $100 increase in oil, I don't spend on, restaurants or vacations or other things. So this is where you get demand destruction. It's straightforward. And that's why oil spikes, they go straight up and they go straight down, and the same violent move up, before long, you get a violent move down. On the supply side of the economy, which is the actual method of inflation that you get from oil, it's different. And so what it does is it reduces the productive capacity of the economy because we're spending more of our budget on oil than productive things like workers or machinery or whatnot. It reduces productivity as well. Both of these are supply-driven inflation factors. Again, but because it's transitory, because of that demand destruction, it will go away and you'll get back that productive capacity and your productivity will improve. That's a straightforward example. And that's what I think most people out there think this is. The issue is with the universal tariffs of 10% at a minimum. Imagine China gets resolved and we go universal 10%. I don't think China gets resolved anytime soon, but universal 10%. It's worse if China is not resolved. But if you think about that from a supply side, it's not a transitory reduction in capacity utilization. It's a permanent destruction of that side. It's a permanent destruction of productivity in the manufacturing sector. And last but not least, it reduces competition, right? So a US manufacturer has to compete with a low-cost manufacturer in Vietnam or Cambodia or Malaysia or China. If you impose barriers such that they don't need to compete with them, they have improved pricing power. And we're seeing companies say we're going to pass on 100% of the cost increases. They're saying that in all these surveys. They said that in the beige book. So from a supply side, it is a permanent destruction of the supply side of the economy, which makes it more persistent than the oil shock. On the demand side, it is also very unusual how this could play out. And again, I don't know. It could play out where we spend more on all these goods, and hence we then retrench spending overall, demand destruction like oil, and that tips the economy over. It's very possible it plays out this way. But it's also possible it plays out in different ways, in that there's no substitutability here. You know, in 2018, he put tariffs on Chinese washing machines. You could go buy washing machines from Canada. You had substitutability. Now, the Canadian price was higher than the prior untariffed China price, but it is still, you know, you had this substitutability to avoid the tariff and paying less than what the tariff was. Here, there's no substitutability. It's every good in the world is going to be tariffed at a minimum of 10%. So consumers have no ability to not pay it. And if they do, it'll be to go back to services consumption, which is the bigger inflation problem to begin with. So if they say goods are too expensive, I go back to services, that's actually not demand destructive. That's more inflation, you know, in the sticky parts of the economy, because goods prices go up and down and services stay sticky. So that's one way it could play out. The other way it could play out is if I'm a worker and I turn and I go to my boss and I say, the government just made me poorer by choice. You know, my situation is worsened. You know, I want higher wages. Now, if I do that in isolation, one worker, the company's going to say, get lost. But if everyone in the economy does it, the corporate sector will have no choice but to raise wages. And so it's very different psychologically to get a supply shock that raises prices from a natural disaster or a virus or something like that that is out of control. The government chose to make you poorer. That could change psychology in a way that I don't think people appreciate. So we could see the wage price spiral. We could also see the household sector say, I have very little debt. I expect this to be, you know, an issue for a year, but 6 months, a year, but I don't expect this to last forever. I'm going to borrow to pay for goods consumption. And then you get monetary inflation on top of supply inflation. So I think people are a little bit too confident that this is just going to go up and then come down. And I don't think it's going to play out that way. And so if I'm the Fed, I think they will have a difficult choice, because we may have transformed the economy from, I'm making up these numbers, 2.5% real, 2.5% inflation using their core PCE, 5% nominal GDP, to something like 4% inflation, 1% real GDP, but on a permanent basis. What does the Fed do? Is the Fed going to be like, this is acceptable? First of all, do they cut if nominal GDP remains the same? No. Secondly, are they going to say, is this acceptable where our living standards are decreasing every year by a very large amount? They're going to say this trade-off is not acceptable. So I'm not sure that the right side, meaning the Fed hikes side of things, is off the table. To me, I think it's unlikely. It's not 50% probability, but I think it's a higher probability that the inflation side doesn't go away and that it has to be dealt with. A simple way you could also think about it is the White House just backed down when it looked like the economy was on the verge of, you know, tipping over. So we may avoid the worst of the growth side of things, but still have sticky inflation, right? So
That's a good way to put it. Yeah.
I think this plays out more. I'm more worried about the inflation side than I am with, you know, a little tick up in the unemployment rate to 4.5, 4.6 or so, because and Powell said this last week, if you don't have anchored inflation expectations and stable prices in the economy, you don't have a stable labor market. And I think that side. So now I'll turn to you. You get both sides of the mandate. Let's just say it's persistent inflation. That's a key assumption to what I'm asking you. You get a key, inflation pops to 5% and is sticky there. And you get unemployment goes to 4.8%. If you guys are the Fed, which one is harder to deal with?
They change their position every month, so I have no interest in speculating on what they would do. But based on historical, they would say we feel very good about our tools to combat the growth side, because they're so far off of zero. I put it like you said. I think hikes are not that likely in the near term, anyways. My base case is they have at least one cut in them to the market, but yeah, if the data is not weakening, they're not going to do it. So that it's really interesting, because even with like equities, back to the multiples they're at, I don't think they do also well if we don't get rate cuts for many months. I mean, I think it's Anna Wong from Bloomberg says she thinks first rate cut is December, which I don't know how the market would stay where it is.
Z5 would sell off 75 bips in that situation, right? We would have over time 75 bips, so, imagine equities responding to that.
Yeah, I was just going to say, I think you provide the rational view of what should occur, but I think the issue is that so many times we've seen them do almost the exact opposite. It's like, like Andy Constant has talked about this so many times, that if the Fed was serious about killing inflation, they could just outright sell their treasuries, instead of doing the rolling off thing. And when I just look at the empirical history of it, it's for whatever reason, we can speculate a million different ways. They often do not go down that rational route. They will go down there, even though it's a lot easier for them to get a handle on the growth side. They're well more tooled for that approach. For whatever reason, they do not go that other route. And, maybe it's, I don't even want to speculate. It could be a million different reasons.
To be clear, I'm not saying they will hike, and I'm not saying that they will do it willingly if they do. If they do, it's like, a kid screaming and yelling and scratching and clawing has to be forced there. So if the doom loop plays out in a very big way, where basically the bond market keeps selling off because you're not hiking, because the dollar is selling off aggressively, that's not hiking for good reasons. And we're only used to them hiking for good reasons. Demand is excess demand, right? But in the 1979 to 81 doom loop that played out, they tried everything. They tried everything and anything to control the situation. And the only thing that did is when Volcker finally said, I'm going to hike rates to very high levels. Again, I don't know how it's going to play out. I'm pointing to scenarios and I'm pointing to analytics that suggest I think it plays out differently in the economy than the consensus has expected, but I cannot predict their reaction function. I could even see a case where they do cut, like Waller's commentary today, he's very dovish. They cut because unemployment picks up. They do have a Phillips curve framework that suggests if the labor market weakens, inflation will weaken. But this is supply-driven inflation. And so I think it's very possible they cut, it backfires, and they have to turn course in 26 or whatever and hike. I just think we need to be open-minded to this playing out in a very different way. But where I'm kind of just trying to, explain to people is if it comes to the point where they have a really acute situation with inflation, where it's not where it has been in the last few years, but is higher and sticky there, and you have a little bit of an increase in unemployment, the Fed can deal with the inflation first and then massively cut to support growth after that. Whereas if they cut to support growth, they may be screwed on the inflation side, right? And so I think that if they work through that logic, which I don't know if they will, but if they work through that logic, it would say prioritize inflation over the labor market. But there's another wrinkle. Could they hike with Trump yelling at them the way he does? That's another wrinkle to this whole story, in that, their independence has been questioned, under threat, and Trump talked that down yesterday because I'm sure he was told that would be a disaster. But in my opinion, the Fed needs to guard their independence. And in fact, and again, I don't know what they'll do, if they were to prioritize the inflation side over the growth side, in a way, that's them being checks and balances against bad policies by the White House. That is a way for them to cement their independence. Whereas if Trump calls for them to cut, they say, no, we won't cut in May, but then they cut in June. They're going to undermine their independence. And also, the buy the dip mentality will be permanent. It will never go away. It will be permanent, and you will be a slave to this for eternity, because everyone knows you can have 5% inflation and you still cut rates. If you know what I mean? Like, it will be, no matter what happens, you can cut rates as soon as there's a wobble. And so I think from an independent standpoint, their next action is maybe the most important action they take for the future of their institution. I hope they choose the right one, which today I don't know what it is, but I hope they choose the right one. I think it will be inflation over labor, personally.
I think that's fair. All right, guys, I think we got to wrap it up there. But Danny, really great to get you on the show. That was one of my favorite roundups in a long time. We covered a lot of good ground, so thank you.
It was better than the last one where I said uncertainty would be lower than 2018 over trade wars. So I think this one will age better than that one.
I forgot about that. That's funny.
Love it.
Yeah.
Good catching up, Danny.
Good to see you guys. Thanks for having me on.
Good.